Good afternoon, everyone, and welcome to our benefits lunch break for the month of May. For those of you that are located around us here in Michigan, hope everybody's enjoying the warmer weather. For those newcomers to this lunch break series, want to just let you know that this is a monthly series that we do. You can see on this slide here the upcoming dates. Generally, the webinar is held at 12 Eastern Time on the third Wednesday of every month. For those of you that are watching our announcements of what we're going to cover, I know many of you were probably expecting us to cover COBRA subsidy guidance from the IRS. That was our honest intent, and we really wanted to do that. But we just kept going day after day and not getting that guidance. Coincidentally, it came out at about 4:30 yesterday afternoon. And so while we did get it before the webinar, it just did not leave us any practical time to get a meaningful webinar up to date. So we subbed in, and I will do my with a different topic, and I'll do the introduction here in a minute, but just want to cover a couple other housekeeping items. If you are interested in kind of looking, I should let you know, we will do a brief overview or preview of the COBRA subsidies on our Monday morning webinar at 8 a.m. I'll be back here if you'd like to join that. And then at a future date to be determined, we will do a separate webinar that goes into more depth on this IRS guidance on these COBRA subsidies. If you are interested in looking at those, you can Google IRS Notice 2021-31. Again, that's 2021-31. The guidance comes in the form of question and answers, so it is actually easier to read than most IRS guidance. One last housekeeping item, we have a webinar this Friday at noon Eastern Time covering potential ERISA fiduciary duty issues related to settlement proceeds from the $2.67 billion, and that's billion with a B, settlement with Blue Cross Blue Shield of the Blue Cross Blue Shield Association, which covers all of its independent licensees, like Blue Cross Blue Shield of Michigan, Blue Cross Blue Shield of Illinois. So if you are interested in that, still time to sign up on our website. Please join us. Lastly, let me introduce our guest speaker for the day, if you will. He doesn't really need introduction. For many of you on the line, it is Jim Brunsma, and he is going to talk to us about missing participants in retirement plans. So with that, I'll give it over to you, Jim. Thanks.
Well, thank you, Trip. Good morning or good afternoon. Today, we're going to talk about some new guidance from the Department of Labor that was published in January regarding missing participants in retirement plans. You can see listed on the screen 3 different pieces of guidance that were published. We're going to discuss each one of them, but the primary focus will be on the first one, missing participants' best practices for pension plans. Even before this guidance was published, the DOL took the position that plan fiduciaries had a duty to locate, or at least make an attempt to locate, missing participants. For the last number of years, missing participants and efforts used by employers to locate them was a significant issue in DOL audits of retirement plans, particularly if you had a defined benefit pension plan. And interestingly, even if you really made a good faith effort, often at the end of the audit, you would get a letter from the DOL saying that you breached your fiduciary duty if what you had done didn't measure up to whatever standards they had, which up until this January never had been published. And the DOL letter would also require corrective actions by the participant, by the employer.
Hey, Jim, can I jump in and ask you a question?
Sure can.
Have you had clients that have gotten these letters, and if so, can talk, just give a general overview of what kind of corrective actions they are required?
Certainly. We've had clients go through DOL audits. Almost invariably, if you have a DOL audit, you're going to get a letter saying that you breached your fiduciary duties, often in the context of missing participants. During the conduct of the audit, the DOL would typically work with the employer in trying to locate the missing participants. Surprisingly, they tried to help. But even if you did all that, they would still send a letter that had a very nasty tone, but they would also require you to adopt corrective actions, including using written procedures and policies so that this type of error would not be as substantial in the future again. The guidance we received in January was the first time the DOL had said anything about missing participants since 2014, when in a field assistance bulletin, they discussed fiduciary responsibility regarding the vested benefits of missing participants in a situation in which the employer's defined contribution plan, like a 401k plan, had been terminated. The DOL Field Assistance Bulletin contained a statement saying, consistent with their obligations of prudence and loyalty, plan fiduciaries must make reasonable efforts to locate missing participants and beneficiaries. So at that point, they were saying, you have a fiduciary obligation under ERISA. The DOL Field Assistance Bulletin then included some specific steps that employers were supposed to take in that context. We're going to talk about the steps that are required under the January guidance. We aren't going to talk about that now, but it's interesting in the DOL Field Assistance Bulletin, they talked about exactly what is an employer supposed to do with the benefit of a participant who's missing. And their recommendation was to satisfy your fiduciary duty that you would do a direct rollover of the participant's benefit to an IRA established for the participant. And their logic was that using a direct rollover to an IRA avoided immediate taxation of the participant's benefit. The DOL rejected two approaches that had previously been used by some employers. The first was to set up an interest-bearing savings account at a bank in the participant's name, or to transfer the amount to the state unclaimed property fund, what some people call is cheating to the state. In both those situations, the DOL stated, these are a last resort because in those cases, the amount would be taxable to the participant in the year in which the distribution occurred. One of the three documents that was published in January was a new field assistance bulletin that updated the one from 2014. It added a new preferred option in addition to rollovers to the IRAs, but in fact, it may be an even improved option. Since 2018, the Pension Benefit Guaranty Corporation, a government entity, has maintained a defined contribution missing participant program. And under this program, if you've searched and can't find a participant in a terminated defined contribution plan, you can transfer the money to the PBGC. And the advantage of this approach is you now have one entity that a participant potentially could contact in the future to find those missing benefits, as opposed to having to contact some random financial institution. And if your employer is no longer in existence, or the people who were involved in terminating the plan are no longer there, it's unlikely anybody would be able to tell you what financial institution you would use or you would contact. But here with the PBGC, you'll have one place you can go to find those missing benefits. Now we want to move to the best practices document, which is the first document listed on the beginning slide. Let's talk about this. I want to make some preliminary comments. First, the best practices document is important. It provides guidance from the DOL, but it's not a regulation, so it doesn't have the same force and effect that a published regulation would. Second, it clarifies that ERISA's fiduciary duties regarding missing participants applies equally to defined benefit and defined contribution plans. Historically, most of the DOL focus had been on defined benefit plans, but now it's clear that these rules also apply to defined contribution plans. Third, an editorial comment. When I speak about fiduciary responsibility, I frequently tell clients that the most important single word in understanding your fiduciary duty is the word process. Are you using a prudent process in carrying out your fiduciary duties? And as we go through the best practices document, you will see a focus by the DOL on process used by the employer. And the last preliminary comment relates to those of you that work for a governmental entity or a church organization. These duties described in the best practices document are fiduciary duties under ERISA, but governmental entities and church organizations are exempt. On the other hand, most people would say that the practices and policies of ERISA regarding fiduciary responsibility are best practices that also ought to be followed by those in the governmental and church sectors.
We got one question from the audience. Can I interject here?
Certainly.
I think a good one that maybe other people are wondering about is, when is a participant considered missing? Is it only when a plan is terminated, or is it when routine mail is being returned as undeliverable?
I think that's a very good question, and it's frankly, a person is missing if you're getting mail back for them.
Mm-hmm.
That you need to take corrective action already at that point.
So it's certainly not waiting until the plan is terminated.
Absolutely not, because at that point, the chance of finding them is going to be that much worse.
Mm-hmm.
And as we go through the best practices document, you'll see an emphasis on doing things as you go.
Okay.
Doing things as you go. To begin, in the best practices document, the DOL contains a series of what they call red flags, which are indications of potential problems. You can break it into a couple different areas. If you have a lot of people who are missing, that would include people who may have left 5 years ago that are still in an ongoing plan. Second, do you have good contact and census data for your participants, particularly those people who no longer work for you? And third, do you have policies and procedures for dealing with undeliverable mail or uncashed benefit checks? So those are red flags that the DOL indicates are indications of a potential problem.
One item here,
Yeah.
just going back to the undeliverable mail. So what if your undeliverable mail is going back to your third-party record keeper, for
Yes.
example?
Yes,
Is that something that maybe you should consider addressing in your administrative services agreement with them?
absolutely. And in fact, your third-party record keeper needs to be your partner in this process.
Okay.
As a practical matter, they're likely to be the first ones to know about these problems.
Because I mean, frankly, all the mail that I get for our 401k plan comes from the record keeper, not from Miller Johnson.
Absolutely. No, that's exactly right. And your record keeper needs to be your partner in this whole process, and you need to work cooperatively with them in addressing these kinds of issues. The DOL best practice document, not surprisingly, includes examples of best practices. But then note that it says that the specific steps to locate a missing participant will depend on the facts and circumstances. For example, if you have a missing participant with a $100,000 account balance, you need to spend more time tracking that person down than somebody with a $25 account balance. So what you need to do in a specific case all depends on the facts and circumstances. Now, this is a mixed blessing. On the one hand, there's not a bright line test that says you have to do everything in every case. On the other hand, the concern is if you don't do something in their best practice list on an audit, are they going to ding you for not doing everything? Mm-hmm. And frankly, none of us know at this point what the DOL position is going to be on audits. In any event, let's go on and now let's talk about some of these identified best practices from the DOL. First one relates to maintaining good contact and census information for the plan's participants. At Miller Johnson, for the last number of years, we have followed the practice in our summary plan descriptions to include in bold type near the beginning of the summary plan description statements to the participant indicating that if they change their address, they need to update that address with the employer and the plan record keeper, because we think it's vitally important that the employer and plan record keeper have good contact information for the participant. This is also something that you may want to emphasize in exit interviews for employees. Remind them that as long as you have retirement benefits at the employer, that you need to keep us up to date on your contact information. You also may want to include a contact change form in any planned communications, and include a process on your online website for a participant to update their contact information. Second, you need to implement effective communication strategies. Obviously, the first one is to use plain English. And the reality is that the average person doesn't understand retirement plans. They don't understand retirement plans. Retirement plans have their own vocabulary, their own language, and writing so it can be understood by a normal person is going to be important. Part of that may involve explaining as clearly as possible what the communication is about and why it's important. Also, you see the last bullet on that slide, if there was a change in the plan sponsor's name or the plan name, the person receiving the letter may not even recognize those names. And you may want to, when sending mail to people in that situation, identify the names they may be more familiar with so they realize that this information is being accurately communicated to them and is not something that was sent to them in error. Now we get to the missing participant searches. And frankly, as soon as you get mail returned, that's going to be a trigger for you to start this process. And you can see from the slide, there are all kinds of different actions you can take, some of which involve checking employer records or plan records. If somebody had designated a beneficiary and you have the contact information for the beneficiary, you can reach out to them. There may be search engines and public databases. Many times you need to use a commercial locator service. Sometimes your plan record keeper does searches for plans. But there's a list of things that are here that potentially can be done. They don't have to be done in any specific order. They don't have to be done for every person. Interestingly, the DOL guidance goes on and talks about some other things. It talks about using social media, about trying to inform people that they may have a benefit from the employer's retirement plan. I guess a concern about using social media is in the age of identity theft. Is that going to cause a potential problem? The DOL suggests, well, maybe you can send out a list of missing participants on your company's intranet. Well, I don't know. Is that going to cause a privacy concern? I think some of the things they suggest may not make practical sense. The things we've listed in the PowerPoint are more likely to be applicable in all situations. If you want to learn more about their other ideas, feel free to locate this document online, and you'll see some of their other items. And they do provide caution that some of this, you may want to talk to your lawyers before you do it. But frankly, once you get returned mail, you need to move on this. Because the sooner you take action, the more likely it is you're going to find the people.
We got two interesting questions that I kind of address here. If we can take just a pause.
Absolutely.
And the first one is, are participants with uncashed checks considered lost, even though their mail is being delivered?
Well, and frankly, I'm very familiar with that problem, as we have clients that have that regularly. If the check is a very small dollar amount, people don't bother to cash it. And then what do? Mm-hmm. There's no way, it wasn't returned, but it's just an uncashed benefit check. You'll note on the last bullet there that the DOL does not say anything about what to do in those circumstances. Unresponsive participants and uncashed benefit checks are two things they say you ought to have a policy about. They don't tell you what to do. Mm-hmm. They tell you what steps to take to find missing people. I guess the question, if it's an uncashed check, at that point, at some point, if the check is stale, you'd redeposit it back in the person's account. I don't think there are good answers for this.
And not that this is a good answer, maybe just confuse things more, but I get this question a lot on the health and welfare side with uncashed medical FSA checks.
Yes.
And one of the positions that we take, and there seems to be some support for this or arguments for this, is that at least if you're a plan, or medical FSA sponsored by a private employer subject to ERISA, those uncashed checks are probably not subject to state escheat
Right,
or
right.
unpaid property laws,
Right.
because they're preempted by ERISA. Well, that would probably be the same analysis here too.
Yes, it would be. Yeah. I normally don't recommend that we
Yeah.
escheat anything to the state
Yeah.
because there was a DOL opinion letter going back to the 80s that said that ERISA preempts the escheat laws.
Gotcha.
But I think that's a real world problem, and I guess the IRS about a year or two ago talked about uncashed checks, and they say, well, they're still taxable. But they didn't address what to do about it from a plan sponsor standpoint. And I think it's a problem without a simple solution.
The IRS largely lives in a theoretical world.
Well, as does the DOL. In my view, the DOL is the most ivory tower of all the ivory tower bureaucrats we deal with.
How do you tax someone on an uncashed check?
Because they could have cashed it.
Yeah. The other question I got, which is interesting, and I don't know if there's a good answer for this one though, is what if communications with all participants are electronic now through third parties?
Yeah.
And so we're not necessarily getting
Right.
uncashed mail. And I know that I've necessarily got, probably old email addresses out there that I've never turned off hanging around, but I certainly don't check anymore.
Don't check them anymore. Yeah, and frankly, that goes back to the idea that we constantly remind participants of the need to provide updated contact information, including email addresses. Yeah, and now the DOL came out with some new electronic delivery of communications guidance. I didn't review that in preparation for this, but I don't know whether that has anything that addresses it.
I guess
I don't think it does.
Someone that's chosen, or if you've chosen and can do it to send just electronic communications, if you have a suspicion that someone may be missing, it's not going to preclude you to send it, something in the mail to their last known address and see if it bounces
Right,
back.
exactly right. Send a certified letter and see if it comes back.
Yep. So just because they're getting electronic mail doesn't mean you're absolutely prohibited from sending them something. And maybe that's a good way to address those folks if you think they may be missing.
Right. Anything else, or should we move on?
We can move on.
Okay, fair enough. And the last of the best practice, not surprisingly, is adopt written procedures and policies. And then once you've done so, keep a written record of what you've done to implement those policies. In theory, by having good policies and procedures and following them, hopefully you're going to have many fewer missing participants. And if you are audited, you'll be able to demonstrate to the DOL that you've been a prudent fiduciary because you've had these procedures and can demonstrate that you followed them. You'll notice also we had on there that if you have a third-party record keeper, you need to work with the record keeper in terms of developing the best possible practices. The third-party record keeper works with many employers, and they may have developed techniques in working with other employers that may be able to help you. I view this as a partnership, and you ought to be partnering with your record keeper in terms of satisfying these kinds of legal obligations. The second document is called the Compliance Assistance Document. This describes the actual procedures used by the DOL in audits regarding terminated vested participants in defined benefit pension plans. Well, what does that mean? We're talking about people who no longer work for you, still have a vested benefit. It's not payable until they get to be retirement age, because that's when pensions normally start. And what are you doing to keep track of those terminated vested participants who may not be entitled to a benefit for another 20 or 30 years? And the DOL has a special project being conducted by their regional offices where they're focusing on these terminated vested participants in pension plans during audits. The next slides are going to talk about the process.
One question, and this may
Yes.
may be unfair, but you always say you're going to ask me unfair questions all the time.
Absolutely, and I better keep on doing so.
Are there any regional offices that seem to be more aggressive in this project, or
I don't know the answer to that.
Okay.
I don't know the answer to that. I know that we certainly have seen activity at the Cincinnati office.
Okay, which covers Michigan.
Which covers Michigan. What kind of information will they request? Well, they're going to ask for the things that were described in the best practice document. They're going to want to look at your census records. They're going to want to know what processes you use for communicating with terminated vested participants and what steps are using to locate missing people. And they also tossed in a couple of extra items. Want to look at the plan document and SPD to verify the plan's distribution rules, and also to get the actuary report to help them understand the plan's demographics. You have a whole lot of these terminated vested participants. And what are they looking for? Nothing shocking here. Errors in record keeping, and then basically inadequate procedures. What I want to particularly talk about the third bullet there. Inadequate procedures for contacting terminated vested participants nearing normal retirement age. For those of you who have defined benefit pension plans, you understand that at normal retirement age, often age 65, a participant's entitled to an unreduced benefit that's paid on a monthly basis for the rest of the participant's life. The DOL feels very strongly that you, as a plan administrator, have an obligation to contact people as they approach normal retirement age to remind them that they have the right to draw this vested benefit. And that, of course, the stakes get even higher if they don't begin at normal retirement age and they get to their point where they have to take RMDs, then that becomes even more important. Employers who were audited initially were surprised to hear the DOL say, you have a duty to reach out to these former employees and remind them that they have vested benefits. The employer would say, don't they know? We send them information all the time. Why aren't they applying? Though the DOL would say you ought to reach out to them and potentially send them application forms. So I think this was a surprise to many employers that it's not just when they get to their required beginning date or required distributions, but as early as the normal retirement age, you need to be reaching out to participants to inform them of their right to begin benefits and to remind them you ought to apply. Notice that once again, they look for last bullet, inadequate procedures regarding uncashed benefit checks, but no idea to tell you as an employer what you're supposed to do. Then how cases are closed. Well, as I mentioned before, the DOL surprisingly can be helpful in the process. They help the employer try to find the missing people. And then they're going to require you to change your policies and procedures. If you didn't previously have written procedures, you will by the end of the audit.
We got one more question before we move on to
Sure.
this next section.
Yeah.
It says, specifically you talked about defined benefit pension plans, but it says our 401k plans are required to follow the same rules as pension plans. For example, upon termination, our TPA sends the participant a distribution package. Unless it is returned, we don't know when a participant is missing. And I think we've kind of outlined those struggles.
Yeah.
That it's probably the return mail is the biggest indicator.
Yes. Well, and then that, I guess that gets down to, they probably get quarterly statements in their 401k plan. Are those being mailed? In which case they come back undeliverable. The third party record keeper would know. They're being emailed. I guess the question is it being bounced back in the email?
And I guess if a participant is eligible for a distribution and hasn't returned the form, then maybe that's another indication we should reach back out.
Well, I guess the issue is just thinking out loud. If I'm a younger participant, maybe I don't want to start drawing my benefits. Of course, I understand I can have the option to roll it to an IRA. I have the option to roll it to a new employer's plan. But I may say, I like the funds that are available with my employer's plan. I'd rather keep the money here rather than take it out as a benefit, by the worst choice, unless the retirement age, or transfer it to an IRA or a new employer's plan. The reality is, if you roll it to an IRA, you're probably not going to have mutual fund options with as low of expense ratios as you may have in a large employer's 401k plan, where because of the size of the plan, the expense ratios are much lower. It may be preferable to the employee to leave the money right where it is. So the fact that they don't return the form isn't a sign of danger. It may be that they're making a conscious choice to follow that approach. But by the same token, if they, as time goes on, we have communications to the participant that are not being delivered, at that point, then that would trigger a search for a missing participant.
We got a similar, just quick follow-up, but I think it's
Yeah.
pretty easily answered. And it says, again, is it just for pension plans? There's also for, we
Also-
have a 403B plan.
Same thing.
Same
thing.
I mean, I think
Rules are the same.
the
That's,
older rules kind of were more geared towards pension plans, but now
Yes.
they apply equally to defined contribution and defined.
yeah, I think that was one of the points at the beginning of the best practices document, that even though many of the audits in the past had focused on pension plans, they made it very clear that it applies equally to 401k, 403B plans, in addition to pension plans. So everything we've talked about is relevant for all types of plans.
And I guess if you have, participants that have left your employment, maybe even years ago, maybe is there a more reason to focus on those that are getting closer to the required
Absolutely.
age? If they still
Absolutely.
got money in the plan and say, we should look at, if they still are leaving their money in the plan, we want to look at them before we look at the 28-year-old that left.
Well, that's true. If you become aware that somebody's not getting mail, you need to look at that right away, because I figure sooner is easier than later. But without question, if you have a defined contribution plan and people are past normal retirement age, at some point they're going to get to the required beginning date for RMDs. And at that point, you have an obligation to start making benefit payments. So I think you're going to want to start the process of tracking them down sometime well in advance of when those payments are going to be required. So I think, once again, even with a defined contribution plan, once people get to be normal retirement age, it'd probably be a best practice to try to make sure that you have good contact information. And if people are not taking the money out, it's not because they're not aware of it, but because of the fact they've made a conscious choice to delay distribution for the current time.
I think that this was a good transition into your next slide.
It is. Yeah. Missing participants are also important with regard to the IRS. We've been talking about required beginning dates and RMDs. That a benefit payment to a participant must begin by the required beginning date. Historically, it was April 1 after the year that a person attained age 7.5. That was changed a year or so ago, and now it's April 1 after the person reaches age 72, unless you were born before a certain date. There's a couple of exceptions that if you keep on working, that you don't have to take payments unless you're a 5% owner, in which case you have to draw at 7.5, even if still employed. Okay, so what? Well, a missing participant may cause the RMDs not to be made timely. And this is a problem. From an employer's standpoint, if you fail to distribute the RMDs, you aren't following your plan document, because your plan document undoubtedly states that these payments will be made. It's a plan qualification issue. Also, from a participant standpoint, there's an excise tax equal to 50% of the RMD that should have been paid and was not timely paid. There is some good news from the IRS on this score. They published a memorandum basically to auditors saying that a failure to pay RMDs to a missing participant should not be viewed as a violation of the RMD rules if the plan has used steps to locate the missing participant. The memorandum from the IRS had specific steps that would be followed, but to cut through this, if you use all the procedures required by the DOL, you're going to be fine with the IRS as well. So from your standpoint as an employer, yes, this is a DOL issue, but it's also a plan qualification issue, and you want to use these steps. So if there are people who don't get their RMDs on time, that you will not be penalized and have to go through VCP because you have an operational error with regard to the plan. Interestingly, one of our clients on a DOL audit of a pension plan had a small number of participants who didn't get RMDs on time, frankly, because they couldn't be found. The DOL, as part of the resolution of the audit, required the employer to follow a VCP application with the IRS. And the point of that was to have the excise tax, the 50% excise tax, imposed on those participants waived by the IRS, which the IRS routinely does in VCP filings regarding a failure to do RMDs on time. Also, as part of that, we got the IRS to forgive the employer about the plan qualification issue. But from the employer standpoint, they incurred the cost of the VCP filing. You have to pay a compliance fee, what most people would call a fine. I think it was probably $3,500. They had the attorney fees involved in this. So way better to have handled it well enough that this type of requirement wouldn't be imposed on the employer. Key takeaways: missing participants are a big deal. You have a fiduciary duty under ERISA to locate them, or at least attempt to locate them, use best efforts. And also, it's important because of the RMD rules, and you want to avoid having plan qualification issues with the plan. You want to avoid the excise taxes for your participants. Also, a key component to satisfying these requirements is to establish written policies and procedures that are designed to avoid missing participants and locate them if necessary. And we can assist you in putting these kind of written procedures together. This is not a huge project. The reality is it's going to be very similar for many employers. But I think it's an important thing for an employer to do. And once they've established these procedures, to actually follow them. At that point, I think we're done with our slides, but if there's additional questions, we're glad to take them.
Yes, so we'll hang around for a couple minutes here and see if you have any additional questions. You can enter them in the question and answer feature. Or if you'd like to talk to Jim about creating these procedures, you can see his contact information is up on the screen. And again, let me just take this minute, a minute while we're waiting for questions, to remind you about the Blue Cross Blue Shield Association webinar this Friday. Amy, our friend Amy, in the chat function, put a link that you can, click on that and sign up for that very easily. And again, we'll dive in hopefully in the next week and a half or so with another webinar on the more in depth on the IRS COBRA subsidy guidance. With that, it doesn't look like we've had any more questions. So thanks everyone for joining. Please come back and join us again in June. And Jim, I'd like to thank you for joining us again in May, and hopefully you'll come back at some point.
Okay, thanks for inviting me, Trip.